You will understand how AI loan systems make hidden decisions that reject applications without human oversight or explanation. March 2023. A woman applies for a mortgage. Credit score 780. Steady income. 0 missed payments in 15 years. The application takes 4 minutes to complete. The rejection arrives in 47 seconds. No phone call. No explanation. Just an email that says adverse factors were considered. She calls the lender. They tell her an automated underwriting system made the decision. She asks what factors. They say they don't know. She asks to speak to a human who reviewed her file. They tell her no human reviewed her file. She asks how she can fix whatever's wrong. They tell her the algorithm doesn't provide that information. She's not alone. Right now, millions of Americans are being quietly rejected by AI systems that no one, not even the lenders using them, can fully explain. And the law says you have a right to know why. But that right has become meaningless. This is the story of how algorithmic lending quietly took over the financial system. How black box AI models now decide who gets mortgages, car loans, and credit cards. And how the laws designed to protect you from discrimination are collapsing under the weight of technology no regulator fully understands. You're about to learn what these systems actually do, why they can reject you without explanation, and what rights you think you have. That don't actually exist anymore. In 2024, the Consumer Financial Protection Bureau, the federal agency responsible for protecting Americans from financial abuse, issued formal guidance on AI lending. The document made one thing clear. Lenders using artificial intelligence to deny credit applications are still required to provide specific reasons under the Equal Credit Opportunity Act. That law, known as ECOA, has existed since 1974. It says if you're denied credit, you have the right to know why. But here's the problem. The CFPB guidance wasn't a celebration. It was a warning. Because across the financial industry, automated underwriting systems were rejecting applications without providing meaningful explanations. And when borrowers asked questions, lenders were hiding behind the complexity of their algorithms. Traditional lending involved a human underwriter reviewing your application. They'd look at your credit score, income, debt-to-income ratio, employment history, and assets. If they denied you, they could point to a specific reason. Your debt-to-income ratio is too high, or you have a recent bankruptcy. Clear. Specific. Appealable. Algorithmic lending is different. The AI doesn't just look at traditional factors. It ingests hundreds or even thousands of data points. Your address, your employment history, how you filled out the application, how long you spent on each page, whether you applied on a phone or computer, even patterns in your name or email address. It processes this data through a machine learning model trained on millions of previous applications. And then it spits out a decision. But here's the catch, the AI can't tell you why. Not because it's keeping secrets. Because even the engineers who built it don't fully understand how it weighs every factor. This is what researchers call the black box problem. The model is too complex to reverse engineer into simple human explanations. Regulation B, the federal rule that implements ECOA, requires lenders to send an adverse action notice when they deny credit. That notice must list the specific reasons for denial. Not vague corporate language. Specific reasons. Insufficient credit history, too many recent credit inquiries, high revolving credit utilization. But when an AI makes the decision, lenders are sending notices that say things like adverse factors in credit profile or information in credit report or application does not meet our credit criteria. Meaningless. Circular. Legally compliant in letter, but useless in practice. The CFPB saw this happening and said, not good enough. In their 2024 guidance, they made it explicit. If you use AI, you still have to provide specific, truthful reasons. You can't hide behind algorithmic complexity. Because here's what the CFPB can't do. Force lenders to stop using black box models. The agency can punish lenders who violate ECOA. It can fine them. It can sue them. But it can't ban the technology. And as long as the models keep operating in the shadows, the explanations will remain fiction. In 2023, advocacy groups and the Student Borrower Protection Center worked with Upstart, an AI lending company, to create an independent monitorship on algorithmic fairness. The final report, released in 2024, found that even with oversight, explaining AI credit decisions remains a fundamental technical challenge. The models work, but they can't be made transparent without destroying their predictive power. And that's the core conflict. Transparency and accuracy are, in many cases, incompatible. So lenders are left with two choices: use explainable models that are less accurate, or use accurate models that can't be explained. Most choose the latter, and borrowers get rejection letters that tell them nothing. Now let's talk about what happens when the black box makes decisions that look neutral, but aren't. This is called proxy discrimination, and it's the scariest part of algorithmic lending. Here's how it works. Fair lending laws prohibit discrimination based on race, religion, national origin, sex, marital status, age, or whether you receive public assistance. Lenders can't ask about these characteristics. They can't use them in credit decisions. That's the law. But AI doesn't need to ask, because the data points it does use, zip code, education, employment history, even your name, are often correlated with protected characteristics. The model learns patterns. It learns that people in certain neighborhoods default more often. It learns that people with certain job types are higher risk. It learns that certain names correlate with credit behavior. And then it uses those patterns to make decisions. The model never says, deny this person because they're black, or deny this person because they're a woman, but the outcome is the same. Because the data reflects historical discrimination, and the AI amplifies it. Federal Reserve researchers have studied this extensively. Algorithmic mortgage lending shows persistent disparities in approval rates by race and ethnicity, even after controlling for credit score, income, and debt-to-income ratio. Black and Latino borrowers are more likely to be denied by automated systems than white borrowers with identical financial profiles. The Department of Housing and Urban Development has investigated these patterns. The Fair Housing Act prohibits discrimination in mortgage lending. But proving an algorithm violated that law is nearly impossible. Because the lender can say, "We didn't discriminate. The AI made the decision." We don't know why, and legally that's often true. The company using the model may not understand how it works. They bought it from a vendor. They fed it data. It produced results. Those results passed internal validation tests. So they deployed it. But if the model is biased, who's responsible? The lender who used it. The vendor who built it. The data scientists who trained it. The historical lending patterns it learned from. The answer isn't clear. And while regulators argue over responsibility, borrowers are getting rejected. Let me give you a real-world example of what this looks like. A small business owner applies for a loan to expand her company. She's been profitable for 6 years. She has strong cash flow. Her credit score is 760. She applies to 3 online lenders that use automated underwriting systems. All 3 reject her within minutes. The reasons given: insufficient credit history, high risk profile, does not meet lending criteria. She's confused. Her credit history is 15 years long. Her business financials are clean. Her risk by any traditional measure is low. But the AI saw something. Maybe it was her industry. Maybe it was her location. Maybe it was a pattern in her previous loans that correlated with businesses that failed in the past. She'll never know, because the system can't tell her. And here's the kicker: she has no right to appeal, because there's no human to appeal to. The system made the decision. The system is final. This is happening millions of times per year. Mortgages, auto loans, credit cards, small business lines of credit, personal loans, all processed by algorithms that operate faster than any human ever could, and explain less than any human ever would. So what can you do if AI rejects your loan? Legally, you're supposed to have options. But in practice, those options have evaporated. Let's start with the adverse action notice. Under ECOA, If you're denied credit, the lender must tell you the specific reasons and inform you of your right to request additional information within 60 days. That's the law. But specific reasons has become meaningless. Lenders send notices listing vague factors pulled from your credit report. Number of inquiries, length of credit history, amount owed. These might be data points the AI considered. But they're not the reason you were denied. Because the AI considered hundreds of other points, weighted them in ways no one understands, and produced a score below the approval threshold. You could have the same credit report as someone who was approved, and you get the same generic explanation. Because the real reason, whatever the model saw in the full dataset, isn't accessible. Now let's talk about your right to dispute. Under the Fair Credit Reporting Act, if information in your credit report is inaccurate, you can dispute it. The Credit Bureau must investigate. If the information is wrong, they have to correct it. But AI lending doesn't just use your credit report. It uses alternative data. Data that isn't governed by the Fair Credit Reporting Act. Data that doesn't have dispute rights attached. Your shopping history, your utility payment patterns, the stability of your address, the type of device you used to apply, behavioral patterns the model learned from millions of other applicants. If that data is wrong, or if the model misinterprets it, you have no recourse. Because you don't even know it was used. The Office of the Comptroller of the Currency, the federal agency that regulates national banks, has issued guidance on AI model risk management. It says banks must validate their models. They must test for bias. They must ensure accuracy. But the guidance is principles-based. It doesn't require specific tests. It doesn't mandate transparency. It doesn't give consumers any new rights. So a bank can say, we validated our model. It passed our internal tests. We're compliant. And if that model rejects you for reasons no one can explain, the bank has done nothing legally wrong. This is the regulatory gap. The laws were written for a world where humans made decisions. Where you could point to a person and say, that underwriter rejected me and here's why. But in a world where algorithms make decisions, those laws have become toothless. The CFPB tried to close the gap with their 2024 guidance. But guidance isn't law. It's an interpretation of existing law. And without congressional action, the agency can only enforce the statutes that already exist. Which means they can punish lenders who provide false or vague explanations. But they can't force lenders to make their models explainable. And that leaves millions of Americans in limbo, rejected by systems they can't see, for reasons they can't know, with rights they can't enforce. But here's the question no one wants to ask. What if the AI is right? What if these models are better at predicting risk than humans ever were? What if they're catching patterns that human underwriters missed? What if they're actually more fair because they don't bring conscious bias to the table? Some researchers argue exactly that. They say algorithmic lending reduces human prejudice. That models trained on millions of data points are more objective than loan officers who might unconsciously favor borrowers who look like them, talk like them, or went to the same schools. And there's some truth to that. Studies have shown that AI can reduce certain types of bias. But only if the training data is clean. Only if the model is designed with fairness in mind. Only if someone is watching for disparate outcomes and correcting them. And right now, in most of the lending industry, no one is watching. Because the models are proprietary. The training data is private. The decision logic is a trade secret. And the only time anyone looks inside is when a lawsuit forces discovery. Which brings us to the final unresolved question: can we have both? Can we have accurate AI lending models that are also explainable, fair, and accountable? Or are we being forced to choose between efficiency and transparency? Because right now, the financial industry has chosen efficiency. And borrowers are paying the price. 1. If AI denies your loan, demand a real explanation. Asterisk, don't accept vague adverse action notices. Under ECOA, you have the right to specific reasons, and you can file a complaint with the CFPB if the lender refuses to provide them. 2. Understand that the model is using data you can't see. Credit scores are just the beginning. Alternative data, behavioral patterns, and proxy factors are shaping decisions in ways no transparency law currently covers. 3. The laws protecting you were written for humans, not algorithms. Until Congress updates ECOA, the Fair Housing Act, and consumer protection statutes for the AI era, your rights will remain theoretical, and enforcement will remain weak. If this kind of investigative breakdown into the systems shaping your financial life is what you want to see more of, subscribe now. Tomorrow, we're looking at how AI is quietly deciding who gets hired, and the discrimination lawsuit that's blowing the hiring algorithm industry wide open. Don't miss it.